Welcome, everybody, back to the Four-Star Podcast. We have our Christmas podcast episode today. I'm Brian Kasal. I'm here. Chris Reardon. Chris Reardon is here. Chris?
Hey, Brian. Glad to be here. Glad to talk a little bit about the markets.
Excellent. Well, and Chris is our Four-Star Director of Development, master of all things portfolio, loves his Cleveland Indians, and he has a golden doodle puppy named Hudson. But most important, he has a new Reardon, Avery.
Yes, he's growing almost 4 months now. It's crazy. Time flies.
Getting some sleep. How about that? And I'm Brian Kasal, founder and CEO of Four-Star Wealth, Eagle Scout, trustee of the National Boy Scout Foundation, philanthropic advisor, CEO and insider advisor, and chief dad to Quinn and Evan, and husband to the amazing Tripty. And again, if you like, folks, what you're hearing, please smash the like button, as they say, and give us a 5 out of 5 ranking on Apple iTunes, where they allow those rankings. Chris and I are going to do the intro to the markets, the economy, and then what we see out there. So why don't we start with that, Chris? What's happened in the tally scores between different asset classes in the market since our last podcast?
Yeah, I think surprisingly not a whole lot, really. Domestic equities is the only mover since the last podcast. It moved down 1 point, but still remains in the number one position at 319. So it lost 1 point from the last podcast. Commodities held the two position, 266, unchanged from the last podcast. International equities held the third position at 210, unchanged. Fixed income in fourth at 127, unchanged. Cash in fifth at 103, unchanged. And still in last, currencies at 57 tally points, and that's unchanged. So, I think some people we've had a lot of volatility over the last couple of weeks. Some people might be surprised, but I think the key here is a lot of this is relative. So even if we've had a lot of choppiness in the domestic equities markets, a lot of that has spilled over into the commodities and even international equities markets. So overall, I don't think we've seen enough movement to really have any major rotations or gains and losses from the individual parts of the economy and markets.
Yeah, it's an interesting time, because while we're not seeing much change in the relationship between different groups, Chris, we're seeing a lot of weird churning going on underneath the surface, right?
Mm-hmm. Yep. Yeah, obviously that's what we're feeling. We're seeing it in energy, consumer discretionary spending. We're seeing it kind of all over the place, but at a high level, not a whole lot's really changing at a very high level, which is what's being indicated here.
Yes. Well, and Bitcoin had a very, very wild weekend. Started at 69,000 per unit, went down to 42,000. Now it's back up, but it's been super volatile. And Chris, one of the facts that I found out this week, that since Bitcoin has made its parabolic move, 55% of the people that are owners of Bitcoin today got in just this year. So that'll show you the hands are weak. All the buyers are new, and they're deciding whether they're going to be in or out, and that's what's creating all this volatility. So that's some of the volatility that we're seeing below the surface.
Sounds a lot like a speculative asset.
Yeah, absolutely. And then also, we've talked in the past about the IPO markets, and generally IPOs, while they get lots of headlines and lots of excitement, and you can buy an IPO and it's an exciting win that day, it's up 20% or 50%. And during the tech boom, some of the IPOs were up even more than that. The initial public offerings generally don't perform that well over time. They're risky, small companies usually, and many of them are below their pricing. This year, about 60%, over half of the IPOs are below their pricing. Compass Real Estate is a good example of that, real estate brokerage. The model really doesn't work for Compass, and the market's starting to figure that out. But the big IPO sellers managed to convince the buyers of IPOs to buy it. A big part of their growth is based on personal contracts that haven't really come. And so there's a lot of issues now under the surface. So in an IPO mania, companies like that will come public without a lot of real great fundamentals behind it. But it's a greater fool theory. You hope to buy it, that someone will buy it for more than you later, and you can get out before it goes down. And that's why IPOs generally aren't great performers. There are some that come out and then they're great, but obviously, and the ones that survive are the companies of the future. but many of them don't even survive. So we'll see. That's what's going on there. Chris, one interesting aspect of this market, however, while the S&P 500 is up over 20%, it's down now, but it was up to as much as 25% for the year. The average stock is only up about 2%, similar to 1999, when the NASDAQ was up 80% and the average stock was barely up, and the average NASDAQ stock was down for the year. The average investor is only up about 5%, with that same thing with the S&P up 20%. So many investors are frustrated this year. And as we all know, investors often take the 1-year view of decision making, and they think whatever's happened in the last year will either continue to happen, or they will make decisions based on whatever happened in the last year. Although in the perspective of a long portfolio growth, 15, 20, 25 years, 1 year is not material, but yet we make decisions about our portfolio based on a 1 year. They call it a recency bias. We tend to believe what's happened is going to happen again. And so, yes, there are things that can be done to your portfolio if you're only up in the mid single digits or low double digits and underperforming the market. But your advisor should be talking to you about those suggestions and tinkering around the edges. There's different programs and different corporate credit programs and all kinds of different things where you can get a better return than 2 or 5%. But if they're not talking to you about that, then maybe you have the wrong advisor. What we find is many advisors in this market are not really practitioners of the markets. And when things get complicated, like they have this year, they don't really have good solutions. So if your advisor is not talking to you about what to do better, if you're underperforming, then you probably have the wrong advisor. So we would offer that. And that's one thing 4-Star prides itself on, is making sure that there's opportunities presented at all times, and that we're not sitting in stuff that's not working. So anyway, many investors will end the year underperforming, and maybe they outperformed last year. And so maybe for a 2-year period of time that they're in line with markets or something like that. But Chris, isn't the S&P rather speculative at this point, where so much of it has been dominated by certain groups?
Yeah, I mean, I think you could look at the FANGs and Tesla and a couple really high flyers, and the percentage they make up of the S&P now is quite ridiculous. I would say, upwards of 30 or 40% in these high flying stocks, and it's not, I would say not, good. You wouldn't be a good financial advisor if you put your clients in 30 or 40% of their portfolios in these extremely high flying stocks. As we learned in 2001 during the tech crash, that eventually it's going to come down. There is a lot of risk there. So it is very frustrating, I think, for clients, because unless you're going to put it all in Tesla and roll the dice, you're going to probably lag. And even a well-diversified portfolio that has bonds or has more value-oriented stocks that may not perform as well either, you're going to lag even more. So, I think the 5 or 6% for 4 or 5% that investors are earning this year, it is going to lag. But I think we don't know when it's going to come back down, but we will see, some of the speculative bubble, if you will, on some stocks pull back probably in the next year or two, but we don't know for sure.
Yes, it's an interesting market for sure. And right now, Chris, the numbers you were alluding to between technology and communications, those two sectors make up over 50% of the S&P 500. And back in 1999, technology got up to in the mid 40% of the S&P 500. Then, of course, by the end of the technology crash, it was less than half that. And the S&P went down 55% from top to bottom. Now, we're not predicting the beginning of a downturn, because it looks like things are heading upward. So we could see the markets continues to slowly rise, but a lot of churn in the groups under the cover, and that's what we've seen this year. So we could see technology stocks and communication stocks slow down, but yet other groups outperform, and then the averages slowly rise anyway, with a lot of activity under the hood. And that's what we've seen this year. That may continue for a number of years. And right now, with stock buybacks at record levels, companies have the cash and they're buying lots of stock. That helps support these prices at these levels as people get in and out of different groups and different stocks. The companies are buying those stocks and supporting the price.
Yep, exactly. I mean, I think it's, I don't expect it to be anytime soon, but like you said, there are certain stocks and certain underlying sectors, I think, that are due for a bit of a pullback, and we'll probably see other sectors run that haven't run yet. So we'll see a little bit of a rotation, if you will, like our models do.
Well, and likewise, there are many major stocks that are down for the year. NVIDIA, which is the graphic chips company, is down. Peloton, the exercise bike and program company. Uber stock is down. Disney stock is down. So those stocks might be bargains here. And we're on today, the 17th of December. So we're right near the end of the year. And any stock that's down in a big up year, many of those stocks will go lower in the next week or two. They maybe bottom in about a week with all the selling pressure just before Christmas. And then these may be opportunities for people who are looking to buy stocks that are now cheap, that were used as the tax loss selling stocks. And if you haven't done any tax loss selling or any mining of the losses to minimize the tax implications of your gains, this is the next week or two to do that, obviously, because you have to do it before 12/31. So those stocks are going to probably bottom here, unfortunately, at the same time you're selling them, and they'll probably rise in January. So there's a whole set of investors that do the tax effect, where they start buying these stocks that are down right around now and selling them in late January, and they get a little pop. So that's another old interesting strategy. So very interesting markets, Chris. We tried to explain some of what's going on, but it's very complicated and people are a little frustrated this year, I'd say. Why don't we turn to the economy? Chris, the CPI and the PPI are up strongly this year, right?
Yeah, so some of the latest, I would say, inflation gauges came out. CPI rose 6.8% in November year over year, which is the sixth straight month that inflation topped 5%. So we are still in a very high inflationary environment. And B, I think the core price index, which is kind of the underlying that excludes food and energy, rose 4.9%. So it's still, the majority of it is even up extremely high, with excluding some of the very volatile categories such as food and energy. So we still are in a very high inflationary environment. Some of the major drivers of that CPI, Consumer Price Index, was new vehicles. They came in at were 11.1% of that November number. And then prices at fast food restaurants were up 7.9% for that number. So, and then underlying, I would say, going back, the Producers Price Index, which is, you can imagine, kind of the raw materials that go into that, and are usually a kind of leading indicator of where the CPI will end up. That rose 9.6% in November year over year. And the core Producers Price Index was up 7.7% year over year, which was the highest on record, actually. So most likely we're not going to see this inflation let up. It'll most likely accelerate, actually, in the next couple months with what this is showing us. So don't expect to see some of this slow down, but definitely very high numbers from an inflation standpoint. And, as it's right now, it doesn't seem to be transitory, because it's been going on for, 6 months now.
So a high PPI leads, PPI above the CPI leads to a higher CPI, doesn't it?
Yeah, usually that's what we see is a high Producers Price Index. If you are having to pay more for goods, you're going to have to raise the end result of what your good costs, correct? You don't want to, no business goes into business to buy, all these different good materials packaged together and then sell it for something that's going to lose them money. So they'll pass those prices on to higher prices onto the consumer.
Absolutely. Well, and the Federal Reserve, Chris, is in a bit of a box, right? And as you mentioned, the inflation isn't really transitory anymore, but the Fed was using that language and saying it was transitory, but it's over a year. And as we checked on a recent podcast, the definition of transitory would be less than a year. So it's over a year. It's not credible to say it's transitory anymore, because it's not. So the Fed, since it doesn't pass the laugh test anymore, to say it's transitory, is now not using that language anymore. They're saying inflation is here. They're trying to stamp out inflation. And what do we do about it? So number two, one issue is the spending, Chris, is now not really helpful to the economy. Yet the current administration keeps pushing for more and more spending. And there's pretty widely regarded view among most economists that the 6 trillion or so that we've authorized to spend up till now, plus all the money that's been put into the banks, 7 to 8 trillion that's been liquefied into the banks, is causing this inflation. So adding more spending really wouldn't help. It would make it worse. And a lot of the money that's been authorized is set to come out over the next few years, so that'll keep inflation high. The claim, the last $1 trillion bill was only for infrastructure, and it would go into the ground, but really only 20% of that was for infrastructure. So a lot of that spending is going to come down, and it was all done on debt and not paid for, which is another big issue, that we have too much debt that we're piling up. So we really need, I think, to stop the spending.
Yeah. At one point I'll make on that. I mean, I think, interestingly enough, obviously it's been in the news a lot. Joe Manchin, the Democrat from West Virginia, I think that's been one of his biggest sticking issues, and holding back this Build Back Better plan, if I can even say it. And the other thing is some of the tricks being played into it, where they're putting programs in there that run for 1 year, when realistically, once you implement something like that, it's very hard to unimplement it. So they'll most likely go 10 years plus for the life of it. So the actual cost is very high. So it's going to be tough, I think, to get it through, which may be a positive and may actually end up in the end helping the current administration, because I think if it does get put through, like you said, Brian, we're going to see it only accelerate this inflationary number.
It is. So because of that, now the Federal Reserve, in their most recent discussion this week on Wednesday, said they want to raise rates, and they might raise it rather quickly. They're talking about 3 near-term interest rate rises. They didn't raise rates in the December meeting, but they're planning to raise them coming into this year. So if the spending continues causing inflation, plus all the spending that's already in the can and ready to come out, then if they're raising rates, they're going to be slowing down the economy, but yet inflation will keep going up. So we've all heard the term stagflation. So that would be stagnant economy with inflation at the same time. So if the Fed does try to slow down the inflation, that will also slow down growth. Now, at the beginning of an economic recovery, interest rates rising is a normal phenomenon, but is demand-driven effect, where there's such demand for money that rates will rise. Now, the Fed might raise rates on the short end, but they don't control the long end of rates. But by raising the short end rates, they'll still put pressure on the economy. And eventually the economy could start to slow as we get to the end of that rate rise. But yet, if the money's still flowing into the economy, we have inflation. So clearly that's not working. And that would get us to a point of more stagflation, Chris, wouldn't you think?
Yeah, no, and then I think a good, we actually have a proper example to a degree of what that would maybe look like in Turkey right now. Turkey's currency, the lira, has depreciated, I think, 50 or 40 something percent. I think it was 41 last I saw, 41% this year versus, broad basket of currencies. And they are dealing with hyperinflation right now. And I think this week they actually just, increased the salaries paid by 50% to all the workers, because the prices of goods is accelerating at such a rapid pace. Obviously, that is a very extreme example, but getting in a stagflation, hyperinflation environment is a very tough position to be put in. And we could see, not to that extreme, but we could see it accelerate potentially if certain things are put into place.
Well, and anyone who was around in the 70s remembers the heavy inflation of the 1970s. And it took the Volcker Fed almost 3 years of extremely high interest rates. Anyone remembers the 20% money markets in 1980? Those rates were designed to choke off the inflation. It also choked off the growth of the economy, and we had a very difficult economy in 81 and 82. And anybody remembers John Cougar Mellencamp's song about farmers and how things were really dire, and it was a very difficult time. I was in college at the time, so I remember it well. And then we didn't really recover in the economy until 1983, near the end of Reagan's first term. So it was a very difficult time. So if we let this inflation get out of control with more spending and the Fed raises rates and chokes off interest rate, we could see a couple years like that of really difficult economy. And this growth economy we have right now will turn sour and go the other way. So let's hope that doesn't happen. So really the most important thing right now is probably to stop the spending and let economic growth demand pull the interest rates up, not just caused by the Fed. Let the growth of the economy raise interest rates on the intermediate term and long end. The Fed only controls short rates, but the key to the economy is the midterm rates and the long-term rates, and those need to go up in a demand pull environment, not a cost push environment. So that's kind of where we are now. Chris, the supply constraints have been bad, but maybe not as bad as we thought.
Yeah, no, I mean, I think they definitely supply constraints, I think, peaked around mid-October. They're still bad, and there certainly are certain sectors, if you will, that are much worse than others, but they definitely have come down. I think, they were up 300%, something crazy mid-October. They're now down. They're up, I think, more in they've almost been cut down by a third. They're down about 100% now and decelerating. So it's only getting better, but that could cause havoc as well. You have a lot of these stores, you have a lot of these manufacturers that are trying to get their goods in the consumers' hands. They're producing more and more. It's getting stuck in this bottleneck. If that bottleneck becomes a lot smoother, those goods will flood the market. And we could see, quite frankly, the opposite. We could see this inflation drop significantly. And if we see that happen, plus we see the Fed raise rates, that's another way that this could go. And that would take maybe a year. It would be more of a long-term, longer in the next couple of months. I mean, that would happen, but that is a possibility. And there's obviously a lot of variables we don't know for sure, but there's a lot out there. And I think the story of the bottlenecks really came up around October, and it's really kind of diminished. That's why you haven't seen them quite as much in the news. And I think for the most part, people were able to get their Christmas goods and shopping and everything, quite easily. I don't think people had problems. You could probably go right now, and for the most part, unless there's specialty goods, things like that, you could probably get what you needed for family as far as gifts.
Well, and many gift buyers have started early this year. They estimate that we're almost done with all the buying. Usually the last minute buying is a big chunk of it, but much of the buying is already done. Although some people did notice in purchasing online, retail inventories were very light and sometimes goods were not available. But what we found is there's a new group of computer buyers and companies that are buying up inventory on Amazon and Wayfair and other sites, and then reselling those goods for higher prices as people panic and go to another site and they find those goods are higher than they would have found them on Amazon, for example. And so we did a article about that on the Leadership Matrix blog. If you go to 4starwealth.com, the Leadership Matrix, we have an article all about that subject up there as well. So it's an interesting time. Now the computers and the computer access is causing efficiencies and creating inefficiencies for people, because others are getting efficiencies through buying goods online and reselling them. So a lot of interesting things going on in the economy. Chris, in the What We See Out There segment of our podcast, we'll move on to, you looked at some things in the international sector.
Yeah, so a couple interesting things. One we've talked about on here is you had the China Evergrande Group. So S&P came out and downgraded their debt to CC, which is one of its lowest possible ratings. Essentially, it's a speculative rating, if you will. And this came after the Evergrande Group officially defaulted on their debt last week. So this will cause, I think, some havoc. It'll be interesting to see how this plays out. And I think this isn't going to be the first one out of China we're going to see. If the government let one property developer in China go under, we're going to see more. So that'll definitely have further implications on the global scale. And then geopolitical tensions we're seeing a lot of geopolitical tensions that are really reminiscent of the Cold War and in some cases World War II rise, as Russia is now Obviously, Russia has been amassing troops on the Ukrainian border over the last weeks. You've probably seen it in the news, but they just released a red line proposal to NATO today, stipulating what they would need from NATO to kind of stand down. And some of what they're asking for really seems very reminiscent of a Cold War. They want the NATO to refrain from military activity in Ukraine, Eastern Europe, Southern Caucasus, and Central Asia. And they want them to pledge not to deploy missiles close enough to hit Russia. So a lot of fear there that really harkens back to the Cold War. Then they would want the U.S. Solely to pledge not to set up bases in any former Soviet Union countries or partner with their militaries. So Ukraine obviously would qualify for that, and I know the U.S. is hopefully looking to reinforce and help them. But there's a lot of geopolitical tension going on there, and I think even on the backdrop of all this has been the gas shortages in Europe, and Russia has been one of the biggest suppliers to Europe, and we just had a pipeline that went through to Germany from Russia that was transporting gas that was just approved. So there's a lot there, and there's a lot of implications it can have not only on commodities but the finances of what happens. So it's something to watch closely if it continues to escalate. I think a lot of it is Putin kind of just testing what the global powers will do, what their appetite is, and how much they're willing to put whether troops on the ground or just do economic sanctions, things like that. So a lot of tension right now, which I think is causing some volatility on top of everything else we've talked about in the market. So something to watch, I think, moving forward for sure.
Absolutely. Well, Chris, you mentioned the issue of dictators like a Putin, putting controls, making demands that no one get involved with the Ukraine and no Central Asia activity, if I remember right. Those issues, and clearly those are strategies that are similar to other dictators in the past, whether it be Mussolini or Hitler. I mean, we've heard these things before, and we hope that it doesn't portend, as you said, World War II, those kinds of things on the world economy. And then isn't coal up big this year as well, Chris?
Yeah, and then other interesting thing is it's so power generation from coal is up. It's up 9% this year. So in 2021, so far it's been up 9%, and that's up after falling in 2019 and 2020. The total power generated from coal decreased. This is the first year we've seen it in the last couple of years increase. And the big drivers behind this increase was China and India, who consume 2/3 of the world's coal. So I know I've seen some stories about how China's burning a ton of coal to make sure the electricity is stable for the Olympics in the next couple of months that are going to be coming up. But they're burning a lot of coal, and it's really interesting because we talk a lot from global warming perspective, ESG, things like that, and you really target America. You see European powers, things like that. Then you talk about China and India, who are increasing their coal consumption there and generating there. So interesting aspect. I thought it was an interesting thing to note with kind of what's been in the headlines the last month or two.
Well, given that coal is no longer going down and it's actually rising, and the fossil fuels are still very strong with prices rising, there is a call to have clean energy, and we're all for that, of course. But some want to do it immediately, like now this year, and completely shut off coal, completely shut off oil, and that would be catastrophic for the economy. If anybody remembers back in the 70s when oil prices went up sixfold overnight, basically from $3 a barrel to around $17, $18 a barrel in oil. And that'd be the equivalent of oil going from about $70 a barrel now to over $500 a barrel. What that would do to our economy? Well, that's what it did in the 70s, same kind of impact. And so that would send us into a very difficult spiral downward, where the oil is restricted so dramatically that prices would explode. And there's no way that other sources of energy could that quickly replace them. So the change to electric and to clean energy needs to be gradual, because it's such a dominant part of the economy. But you're no doubt about it, everybody's for clean energy, but it's got to be gradual. Chris, there are some other interesting Wall Street things too, I think.
Yeah. So then I'll kind of wrap up with the forum application from Reddit, which I think most people have kind of heard of from Wall Street Bets, most famously. They're looking to IPO. So it's going to be a really interesting gamble, I think. Obviously, Wall Street Bets runs on their website. So is this Wall Street Bets going to pump up the IPO for Reddit after it goes public? So they recently filed a lot of their the paperwork, preliminary paperwork. So I haven't seen a date yet, but that's kind of one of the recent tech companies to kind of take a foray into the public markets. And then Harley Davidson, talking from an electric and ESG front, Harley Davidson is looking to spin off electric motorcycle division as they kind of attempt to jump into the electric vehicle space. So we've seen that, I think only amplify. I feel like electric vehicles now is kind of the .com, the late 90s. It's, if you're a car company, you have to have an electric vehicle division because that's the new age. So it's really interesting to see everyone's kind of trying to migrate in that direction.
The new Hummer, electric Hummer, is going to be 113,000. Isn't that right? Something
that's crazy. And I think I saw today, because it was brand new, released today, there's going to be some ridiculous amount of batteries are going to be able to stack in that thing too. So, it's definitely, I think, the future. But, once again, and it's good that they're looking and researching it. I think the efficiencies need to get better. Obviously, we need to, from a producing electricity standpoint, that needs to get better. And I think we need to have more sustainable, renewable energies before we, fully take the plunge and decouple from fossil fuels.
Absolutely. Well, Chris, we're getting to the end here. A couple other additional comments. We talk a lot about capitalism and the difference between that and other forms of economic growth and running an economy. And capitalism, provides individual actors with the freedom and liberty to make decisions in the economy and the economic system. And it helps everyone when the individual actors allocate their capital rather than have governments do it. The way communist and socialist groups or countries manage growth is they like to acquire. And maybe that's what Putin's thinking about Ukraine. He already went into part of Ukraine a little while ago, and socialist, communistic governments and economies don't grow. So for them to grow, they've got to acquire, just like companies would buy other companies. But our system in America has caused an immense internal growth and intense internal growth over the years, created some of the largest wealth. There are more millionaires in America on a relative basis than any other percentage in any other country in the world has ever seen. And so, in their case, the larger powers, their influence. But that's really only short-term thinking, because eventually all those economies that are based on socialism and communism break down. And we're seeing it in China. China attacked IPO companies right after they came public. And that's no way to run an economy. President Putin is meeting with President Biden, or recently did, to talk about, trying to keep him out of Ukraine and putting restrictions on what others can do in Central Asia. They want to harvest those resources there. They are interested in influence, whether it be an acquisition or just supreme influence. China is building a new base on the east side of Africa. They have one on the west side of Africa now. So they're increasing their influence more and more in Africa. And again, that's just to acquire influence and control. So we see freedom and capitalism as the way to go over time. And those economies that don't do that, they have to do acquisitions. And we really wish the rest of the world would learn how to run capitalist economies. Anyway, we'll see how that all develops over time. A couple last things, Chris. New York City is instituting a new sweeping vax mandate on December 27th. And there are some other vax mandates that have been overturned by the courts. There's not a single vax mandate that has not yet been overturned by courts. So if they keep putting on vax mandates, that could severely limit growth. It could limit the growth of New York City, but there's a new mayor coming in about 6 days after that vax mandate. So maybe a lot of the people there who are required to get a vaccine will just ignore the rule and wait for the new mayor. We'll see how that goes. And it won't really help the pandemic. The economy, has been gripped by this for a couple of years now, but the new variant is very close to the common cold. A lot of concerns are waning. So hopefully we are coming to the end of the pandemic-driven economic issues. The former CDC director, Robert Redfield, had said up until he left in early 2020 that the masks had no science and didn't work, and distancing wouldn't work either. Now, no one's talking to him anymore because the current administration wants it done differently, but that's what the previous CDC director had said. So if, we'll see where it goes. If we keep adding more and more restrictions and we keep adding mask restriction and things like that, it could affect the economy, but our hope is that it's limited from this point on. So Chris, we had a great podcast today. Chris and I and all the members of the 4-Star team just came back from a fabulous conference in Mexico. We had 28 vendor organizations join us there. We had 35 advisors from 4-Star and other affiliated firms. We had a fabulous time, learned a lot. We had our Christmas party down there as well, that we all put on Santa hats, thanks to Tucker Dunn and Chris Wanneberg, who acquired the hats and brought them down to Mexico. So we had a great time. And, this is a great holiday season, Chris, and we want everybody to enjoy, and we want to wish everybody a great, happy holiday season. Some groups have already celebrated the Hanukkah and Kwanzaa. Now we're coming into the Christian holidays, and we want to wish everybody a happy holiday season, Chris, huh?
Yeah, happy holidays. Probably happy new year, I think, by the time our next podcast comes around. So hopefully 2022 we're on to bigger, brighter, and hopefully a good year.
Yes, I think 2022 will be a great year for America as we come out of this pandemic, as hopefully we manage our economy well, and we continue to be the leading economy in the world. America stands for freedom, liberty, capitalism, and we're the leading economy in the world, the leading country in the world, and we certainly hope that continues. Thank you all for being with us this year on the 4-Star podcast, and we will continue with a new episode in the new year. Thanks for all being here, and we'll see you next year.